Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, January 4th, 5:10 p.m. Eastern Time, coming to you from Mantua, New Jersey, with tonight's Revere Market Insight video. Downgrade in market leadership. State of the market continues to be in an uptrend based on where we are on the major indexes, where we broke above the 21 and the 50 or in the final week in December. As far as market leadership goes, high valuation stocks getting decimated. That's a clear sign that pension funds, hedge funds, institutions are getting out of anything they deem as too expensive in preparation for the Fed tapering and moving into growth isn't dead, but growth, high valuation growth is. Growth at a reasonable price is holding up just fine. But downgrading leadership, market leaders from bullish to neutral. Still green across all three time frames, which means that the five major indexes that we track are trending above their short-term 21-day, medium-term 50-day, and long-term 200-day. Actually got two closes in the small caps above the 200-day today, but they're still stuck below the 50. So that's what these little yellow arrows here mean. Let's see if we can close the day or close the week above the 200 and the 50-day. But all of the heavy lifting is being done by the value half of the large cap, small cap, and medium cap indexes. We'll take a look at charts here momentarily. So what just happened today? Dow Jones Industrial Average leads, high valuation hit again. You can see the G5 down 1.7%, S&P 500 just fractionally down, NASDAQ 100 down 1.3%, Dow up 0.6%, mid caps up 0.5%, Russell down 2%. Let's go to the tail of the tape, but first let's go to the team here at Revere. Clients, be on the lookout for a special year-end video that'll be coming your way, summarizing our process and performance and taking a look at over the really historic markets over the last 2 years. So if you're interested in an approach that is, we're trend followers, we participate in market uptrends, get out of the way in market downtrends, tread lightly when the market's going sideways. And if you're interested in an approach like this, give us a holler. You can email any of us, Dan, Tim, Hunter, Mural, Alex, or Don at revereasset.com, or give us a call, 855-REAL-WEALTH. That's 855-732-5932. So let's get to the tail of the tape. So headwinds continue for the market. Strong dollar, Omicron, obviously, inflation, and the Fed tapering. So these, and especially the way that that interest rates rose the first 2 days of the year, that had a direct correlation to the high valuation stocks getting hit. Let's take a look at TLT. So when this drops, the price of the bonds rises, and you can see the strong breakdown out of this, what looks kind of like a bear flag, closer to the bottom of the range. We want to see if this 140, 145 level helps. Big move down. We did finish off the lows today. Let's go to the 10-year. And you can see the breakout here yesterday. And again, we're at the top of the range here around the 1690, 1693. Top of this range goes all the way back to May and March, where it was between 17 and 1765. This big run up here corresponded with the last big sell-off in high valuation growth stock. So this run up here made tough sledding for growth stocks also. So, and now we're seeing a breakout above this area again. So keep a key eye on this 17 level, and then let's go to the weekly, 1765. You can see this goes all the way back to 2019, where rates were this high. So we passed this 1765. We're really in multi-year highs at that point. See if that corresponds with the Fed tapering. Maybe the economy slows and they don't raise rates or taper the way they initially planned, but that usually shows up in the markets before it shows up in the economy. So As always, we'll keep an eye peeled for the charts. So back to the tail of the tape. Nothing really jumping out from a sentiment standpoint. Bull case, we want to stay above the 21 and the 50-day moving average, which we reclaimed back on 12/21. Let's go to the S&P 500 chart, and you can see where we got back above here. 12/21 on this harsh move. Now we've just been consolidating that for 7 days up here near the highs, but a lot going on underneath the surface between value and growth. So let's first take a look at SPYG. This is S&P 500 growth. Doesn't look that bad today. Actually, this is yesterday's. Nope, that's today's. Okay. Bounced off the 21-day moving average, but look at SPYV. Huge up, the breakout up 1.02% today. So up 1.2% while SPYG was down 0.8%. That's a pretty big bifurcation. Let's go to mid caps now. MDYG. The growth portion down 0.23%. Not damage done to the chart yet at this point, but the point is that the value portion of the indexes is far outperforming. Here's MDYV value. You can see the break above recent resistance here, and this is really industrials, banks, and oils, which really have been carrying the water on the indexes. Let's go to IWO, the growth component of the Russell 2000. You can see that down 1% today. How about IWN, the value component, up 7.2% today. So very clear divergence between growth and value, especially high valuation growth, which is just absolutely getting hammered. Let's take a look at some high valuation charts here. Datadog. Their PE is 482 versus a growth rate of 45%. Decimated the last 2 days, down 8% and down another 4%, although it did bounce at this 150 area. So we're always looking for support in these, but right now this is a broken chart as it was coming up the right side. That's failed now. NEWR, another promising software stock. Software just got really hammered. Another 2 big down days on that. How about Fortinet? I'm going to show the 2 best looking cyber stocks that we had on our watch list. Broke out to new highs last week. Epic failure on that breakout. Down big 2 days, down toward the bottom of its range. Palo Alto, the second one. 2 harsh days, another failed breakout there. Let's look at some indexes for software stocks. First, IGV. This is the broad one. This contains Microsoft, which still looks good but broke the 50-day moving average. Let's look at Adobe real quick, another big one. That looks awful. That's primarily responsible for why IGV looks the way it does. That and the Microsoft held it up for a while, but can't hold it up completely as it broke the 200-day moving average. Now let's look at some high valuation ETFs. These are cloud ETFs. Here's Sky, below the 200-day moving average, matching the lows from the last month and a half. Here's WCLD, another cloud ETF. Broke to new lows far under the 200-day moving average, and CLOU is another cloud ETF. Break into new lows. These things just getting taken to the woodshed. So brutal selling in software. That was really the area that got primarily hit. But let's take a look at the G5 index. I already showed IWO and how that was down 0.99% today. FFTY, the second component of our index, down 1.1% today, again breaking below the 21. We want these G5 indexes to be above the 21 to give us some confidence that growth stocks have the wind at their back. But this breakdown just confirms what we saw yesterday with the harsh reversal, that the wind is now in our face in growth. And we're really the only stocks that are tech that we own left have very reasonable valuations. QQQJ, again, breaking down under the 21, under the 200 to new lows. That's another component. PDP, another component, breaking down the last 2 days. And finally, the ARC, just awful. not breaking a new low, so it's holding the lows of the past 3 weeks, but cannot get even above this 21-day moving average. While the other 4 did over the prior weeks, RK didn't, and they already had some beaten down stocks in there that Kathy Woods continues to average into, not going very well. The market leader Tesla had a very harsh reversal yesterday and broke below the lows. This 1200 area just couldn't be pierced yesterday or today. This was a big disappointment for people that bought into this gap yesterday. After it gapped, we moved our stop from below the 21 to below the low of the gap day to lock in profits, and took those profits when it broke below it today back into the body today. This is still a market leader, and it's something we're keeping an eye on for overall direction to the market. The other big market leader is Apple. Still acting fine, pulled back, but on lighter volume than yesterday. And as far as growth at a reasonable price goes, Micron Technology, this is our biggest position. Note the growth rate only 14%. I'm sorry, the PE 13%. Growth rate next year 31%. Look at the PEG ratio on stops. That's the PE ratio divided by the growth ratio. And if that's less than a 1, you've got a very fair valuation on a growth stock for there. So that's something we're keeping an eye on. Compare that to Datadog, which I showed before, that had a 472 PE. So it's not that all growth is dead. It's that growth at a reasonable price is displacing growth stocks that are just have ridiculous valuations. Let's look at Qualcomm. This has a 22 PE. Growth rate in 2022, 26, so that's below 1 also. So those things really not, that bounced today at the 21 and had an outside positive reversal, so a good sign there. 2 stocks that had nice days yesterday but gave it all back today. Nvidia actually closed below the 50-day moving average, although well off its lows. AMD with a great day yesterday, outside negative reversal, reclaim the 50-day moving average, but that's not the type of action that you want to see in these stocks. But again, ones that are reasonably priced are holding up okay. Here's Broadcom, 24 PE, 2022, 18%. So that's just a little over 1%, but that's holding up just fine. So valuations matter when bond yields are going higher and bond prices are going down. So that's what I had here for the news. High valuation growth continues to get crushed. Do we have any follow through to Monday strength? No, we really didn't, although we did finish quite a bit off the lows. Let's go to the S&P 500 and look at a 5-minute chart here. We had a gap up and then held for a while, and then a very harsh move down during the 10 o'clock Eastern hour, a little bit of a bounce, made a lower low, then a strong reclaim into the close before selling off the last 10 minutes. So overall, as long as we hold this 47.58 level, let's blow this out to a 30-minute chart here. This 47.58 level, maybe 47.50, that's really the breakout area here. As long as we hold in this range 1, 2, 3, 4, 5, 6, 7 days now in this breakout range, keep a very close eye on that. Should we break below this 47.50-ish area and go back into the prior range, that means we've got a failed breakout and we've got to take defensive action. Let's go to the NASDAQ 100 here. Daily chart. Bounced off the 50-day moving average. This was looking a lot uglier than it closed, but still down 1.3% on the day. But notice it hasn't broken out. But let's take a look at something that did break out, and that's the Dow, the big leader today, up 0.6% above this recent range. Serious relative strength over the last week. Let's go to mid caps. Mid-cap value has been holding up this portion of it, as I just showed before, but you can see still coming up the right side here. IWM, small caps, again led by the value component of it the last 2 days, but 2 days above the 200-day moving average. We want to get a weekly close above the 200 and ideally a move above the 50-day moving average, which has been acting as resistance for quite a while. Back to the tail of the tape here. In our portfolio today, we trimmed, or actually sold, CMG, Tesla, DHI, and Toll. DHI and Toll had hard reversals yesterday, bounced on lighter volume today, so we took the small profits there. CMG just completely came apart. And I guess we're considering this a high valuation stock. I don't know. I didn't expect it to act like this when it reclaimed the 50-day moving average, but a close below the 200-day moving average today after breaking the 50 and the 21 yesterday certainly got us out. Key sectors today: oils, financials, industrials, base metals acted very well. On the downside, I already mentioned all of the software stocks that got hammered. Healthcare, a rough day today, led primarily by a beatdown in biotech. Let's take a look at XBI. And again, these stocks very often have zero earnings, so they really require a lot of confidence in the market to go higher, and they've been lagging, frankly, for quite a bit. So where are we right now? We're at 47.94. That's day 7 in this 47.40 to 48.08 range. We actually made a higher high today, so that went up to 48.18. But this is the range that we've been in for 7 days now. If we break back into this 47.40, as I mentioned, then the breakout has failed. Anything else I really want to talk about here? How about I mentioned some stocks that got taken apart. Net has round tripped now this entire breakout. And I actually have a second dirty 30, another 30 stocks that dropped 30 or more percent. As I mentioned, we've had a stealth bear market, 2 of them now. The first one was in the first quarter, started mid-February, and the second one here in November into December. We managed to dodge this one for the most part, got hit hard in the one that happened in the first quarter, but again, that spawned the G5 that we keep an eye on, and that's really the weakness in that is what led us to not be overly exposed to high growth stocks over the last couple of weeks. So that's going to wrap it. As always, like to hear feedback from you. I'm on Twitter at dvandenbord, email don@revereasset.com, phone 855-REAL-WEALTH. Wrapping up Tuesday, January 4th. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.